You swipe your card. A coffee, $4. It feels instant, effortless, clean. But somewhere between your tap and the barista's screen, value quietly leaks out of the system. Not stolen, not scammed, just shaved. So slowly and so evenly that almost no one notices. It's the invisible tax you pay when money moves too fast. And right now, money has never moved faster. In 1970, a dollar might sit in a bank account for weeks before changing hands. Today, the same dollar can bounce through dozens of institutions in milliseconds. Stocks change owners in microseconds. Currencies trade around the globe while you blink. Trillions of dollars race through pipes built for speed, not stability. Speed feels like progress, but in finance, speed changes who wins, who loses, and who quietly pays for the system to work. Let's start simple. Imagine a small town with 100 people and $1 million. That money moves slowly. It circulates. People get paid, buy groceries, invest, save. Now imagine the same town, but the money moves 10 times faster. The same $1 million changes hands 10 times as often. On paper, nothing has changed. Same people, same money, same goods. But the faster money moves, the more often it passes through toll booths. Transaction fees, bid-ask spreads, payment processing, currency conversion, high-frequency trading margins,
Consider
liquidity
this point
premiums,
carefully.
inflation
The data
expectations.
suggests a clear trend
Each one
that we
tiny,
cannot ignore
each one
if
rational,
we want to move forward.
each one just the cost of doing business. But stacked on top of each other, they become a tax. Not voted on, not printed on a receipt, not debated in parliament. A tax on velocity. In slow systems, friction is visible. You wait days for a wire. You notice bank fees. You think before moving large sums. In fast systems, friction becomes invisible. A tenth of a cent here, a microsecond advantage there, a slightly worse exchange rate you never see. But when trillions of dollars move at near light speed, tiny frictions compound into enormous transfers of wealth. This is where the story turns uncomfortable. Because the people who benefit from speed are not the people who use money. They're the people who sit between movements. Market makers, clearinghouses, payment networks, high-frequency trading firms, liquidity providers, intermediaries with algorithms instead of storefronts. They don't produce goods, they don't consume much, they skim. Not in a criminal way, in a structural way. Take stock markets. When you buy a share, you think you're trading with another person. In reality, you're trading with a machine that exists solely to be faster than you. It buys at one price, sells to you at a slightly higher price, keeps the difference. That difference is called the spread. It looks harmless, but multiply it by billions of trades per day. That spread is a tax on movement. And speed is what makes it possible. The faster the market, the more valuable being first becomes. The more valuable being first becomes, the more money flows into building speed. Fiber optic cables under oceans, microwave towers across continents, data centers next to exchanges measured in feet, not miles. All to shave microseconds. Not to make the economy more productive, but to capture fractions of cents millions of times per second. Now, zoom out. This isn't just stocks. Every time money moves quickly across borders, someone arbitrages exchange rates. Every time debt is rolled over instantly, someone earns a liquidity premium. Every time a central bank injects cash and it races through financial markets before reaching wages, asset prices move first. That's the Cantillon effect. The first recipients of new money benefit, the last recipients pay higher prices. Speed decides who is first. So the invisible tax has two layers. First, direct friction. Fees, spreads, margins, slippage. Second, timing advantage. Who touches the money before prices adjust? In slow economies, these gaps are small. In fast ones, they become structural. Think about inflation. When prices rise, it feels like money is losing value. But that loss isn't evenly distributed. Asset prices react in seconds, wages react in months, rents react in years. Money reaches markets before it reaches people. By the time it reaches you, the purchasing power has already been diluted. That dilution is another form of the same tax. A tax on being slow. And most humans are slow compared to systems built on silicon and light. Now add leverage. Fast money doesn't just move quickly. It moves multiplied. A single dollar of capital can support $10, $20, $50 of financial exposure. When that leveraged money moves fast, small price changes create large gains for those positioned early and large losses for those forced to react. Crises become snap events. 1987, markets crash in a day. 2008, liquidity vanishes in hours. 2020, entire asset classes freeze in minutes. Speed compresses time. Compressed time removes buffers. No buffer means no margin for error. And when the system breaks, the cost is socialized. Bailouts, quantitative easing, emergency lending. The invisible tax shows up again, but in reverse. Losses move upward to balance sheets. Stability is purchased with future purchasing power, which means with future inflation, with future debt, with future currency debasement. Again, a tax. Paid later. Paid quietly. Here's the irony. We built fast money systems for efficiency, to reduce friction, to lower costs. But after a certain point, speed doesn't remove friction. It concentrates it. The faster the system, the more valuable being infinitesimally ahead becomes. The more valuable being ahead becomes, the more resources are spent on speed. The more resources spent on speed, the more the system extracts value without creating anything new. It's a race where the prize is skim, and everyone else funds the track. You see it in everyday life. Instant payments feel free, but merchants raise prices to cover processing. Real-time trading feels liquid, but long-term investors quietly lose basis points. Fast monetary stimulus feels supportive, but living costs drift upward before incomes do. No line item, no receipt, no headline. Just a slow erosion. The invisible pax vitae when money moves too fast is not a conspiracy. It's not a plot. It's physics applied to finance. When movement approaches zero time, advantage becomes everything. And advantage is monetized. The system doesn't ask whether speed makes society better. It rewards whoever can exploit it. So the real question isn't whether we can make money move even faster. We can. We will. The question is, at what point does speed stop being progress and start becoming a silent redistribution machine running in the background of the global economy, charging everyone a fee for keeping up with a world that no longer waits?